Eugene, thank you again for the intro earlier. It's really great to be back here today and to be a part of the BCI family. Before we get into today's story, let me just provide you with some context and some background on the Mazi Global Equity offering. As things stand today, we have about 1.5 billion under management. We have a substantial portion of our own net worth and family money in the fund. We've got a lot of skin in the game. In terms of the Mazi BCI Global Equity Feeder Fund, we've got a 3-year track record now, and at the end of December, we'll hit the 4-year mark. Our underlying dollar UCITS fund in Ireland will have a 1-year track record at the end of November. We follow a proven, repeatable quality investment process that most of you will know if you've been listening to us previously. I've managed global equity for more than 50 years now, and I have a team of 6 investment professionals at Mazi working on global equity, and they do this work from Cape Town and Joburg. Today, I'm going to tell you how we at Mazi manage global equity from South Africa. We're going to talk about the importance of a clear quality investment process and philosophy, and the value and use of data analytics to us in our repeatable investment process. And then also we're going to talk about the importance of global travel. A compass and a map are always a good starting point for any job, for any journey at least. The compass keeps you going north, traveling in the right direction, and the map helps you to navigate the terrain. Think of our investment philosophy as a compass to global and map to global markets and the global investment universe. It shows us where to go and what to avoid. So what are we looking for when we look for a global quality company? First off, we want decent, honest, experienced management that is long-term in their thinking and have demonstrated a track record of rational capital allocation. That means that the dollar invested today in the business will give back more than $1 in profit tomorrow. Next, our operators must drive the wedge of innovation and competitiveness. Year after year, our businesses must get better and more durable. These are moats, as Warren Buffett calls them, barriers to entry, technology, IP, brands, networks, customer bases, and so forth. But being profitable is not good enough for us. Our businesses also have to grow. And markets, as you well know, reward profitable growth over time. So if the story with a company is great, we also expect to see it in the numbers. It has to show up. You can fool some of the people some of the time, but not all of the people all of the time. Our businesses must demonstrate sustained margins that are really, really wide, generate lots of free cash, and result in high returns on invested capital. But we're shareholders, so we own things on a per-share basis. So it has to show up in the per-share numbers. So that practically means that our companies must motor not just in terms of per-share earnings growth, but also in per-share cash flow generation. And lastly, we've got to be patient. Good things happen to patient investors. I've now told you and shared some of the high-level attributes that we look for in a quality company, but what does that actually look like in the real world? Here's a picture from our data analytics of Meta. The red line is the cost of capital for Meta over time. In other words, of the capital invested in the business, what do investors expect to return on? Today, you can see Meta has a cost of capital of about 10%, so that's on the right. The green line is the actual return that Meta earns on this invested capital. In other words, how much do they really generate for the shareholders? And that number you can see is about 26% on the right. The gray bars, that represents the difference. It's the EVA, or the economic value add. The bigger that gap, the better. That means the business is intrinsically more profitable. So bigger is better for us. And the purple line is really interesting because that's the cumulative progression of these excess profits that this company generates over time. We call it the financial DNA, or the fingerprint of Meta. Now, whatever haters have said in the past about Meta, we could not disagree with more. Whatever the noise, this picture shows the true quality of Meta. Now, we're a team of about 7 investment professionals, so our team size is not that different from other well-regarded quality managers. But how do we then find the best quality companies in the world? And for that, you need a solid process and great data analytics to identify those companies and only those companies that meet the criteria of your clear investment philosophy and process. The global equity universe is truly huge. There are about 97,500 instruments listed out there that represent probably about $125 trillion of market cap. We track 90% of global market cap daily. The benchmark, the equi, it's about slightly less than 3,000 stocks. And within all of this, we've found about 120 companies that potentially make the cut of our quality investment criteria. It is this list that we do very, very deep and extensive fundamental research on. And from here, we build a long-term portfolio of about 40 stocks. This screenshot also comes from our data analytics engine. Every single day, we evaluate 90% of global market cap. We are able to identify and shortlist companies that potentially meet our quality criteria. As you can see, some of our existing holdings are highlighted in yellow: ProMedicus, Qualis, Paycom, Arista, Deckers. They remain today some of the most attractive investment ideas in the world right now. The columns on the left in purple and red deal with return on invested capital, intrinsic profitability, growth, and the acceleration of profitable growth. We track all of these things. To the right of this chart or the table, we score every single company in our universe on the basis of various factors to evaluate the relative attractiveness of this business in the context of all other companies in the world. In very crude terms, we express a valuation view both over the short term and the long term in terms of everything that is out there. This is why it is possible to buy a high PE stock and still get a multi-bagger return, but also avoid a low PE stock, which turns out to be a value trap. The key takeaway from this slide is that machine learning is used to identify, test, and evaluate those factors that are predictive of long-term investment returns in a statistically significant and economically sensible way. What matters for us is what the stock does for investors and nothing else. And that is the key here. In our view, data analytics greatly assists us in idea filtering, fundamental analysis, and risk management. Right. This may be a bit of a delicate matter to some, but the point is well made. You can never underestimate the importance of travel and on-the-ground experience. You never know what you may find. Back in 2016, when Steinhoff announced the deal to buy Mattress Firm for $3.8 billion, that was about 50 billion rand at the time, so still a lot of money today, we own Steinhoff in some of our global portfolios. I sent one of my colleagues to the US to take a look at Mattress Firm. He came back shocked by what he had seen. It was a Mattress Firm store was like an old Ellerines or Bears store, but much worse and only selling mattresses. I remember sitting in an investment meeting saying to my colleagues, when you sell mattresses, you make this much money on each mattress. Do you have any idea how many mattresses you have to sell to pay back the price? The deal doesn't make any sense. We sold Steinhoff immediately, thankfully. But we are trying very hard in our daily work to avoid the next Steinhoff. And that is why we apply data analytics to a very clear investment philosophy and process. Look at this picture on Steinhoff and compare to the picture that I showed you previously on Meta. Of all the things you could have owned in the world, a quality investor would never have gone there. They would have never owned Steinhoff in the first place. You did not need to believe that management was dynamic or that Steinhoff would one day be bigger than IKEA. The truth be told, Steinhoff never cut the mustard. The business was never intrinsically profitable. For the most part, return on invested capital never really exceeded the cost of capital. Steinhoff was a serial capital destroyer at a great cost to many. Enough said. Travel is critical in what we do. We've spent a lot of time on the road since September 22, when international travel opened up after COVID. In just 2 years, we've done about a dozen trips. We've been 4 times to the US, a couple of times to Europe and the UK. And the last year alone, we visited China on 3 different occasions, meeting with companies in tier 1 and tier 2 cities. If you haven't been to China, do yourself a favor and go. You'll come back with a very different perspective. The media in the West misreports about 90% of what you read, in my opinion. We have one direct holding in China, but gain lots of exposure through quite a number of our global companies that sell their products and services very profitably and successfully there. China remains a hugely interesting and significant place and an important long-term opportunity set. I've just returned from the US, where I met with quite a few of our portfolio companies. We interacted there with about 40 different businesses, and all of our interactions were aimed at improving our investment process over time. Data analytics and machine learning are also hugely important areas for us. We are constantly upgrading and improving our proprietary tools as they form the basis for idea filtering, fundamental analysis, and risk management. Last year on the travel front, in November, our luxury goods analyst is heading off to Europe. We hold Hermès and LVMH and intend to deepen our understanding of this very important sector. Let's finish off with one last story. We own Zoetis. In 2013, this company was spun out of Pfizer. So these are the guys that make Viagra. We met them again in September in New Jersey. Now, Zoetis does animal healthcare pharma, and at its core, it's a research and science-led company. Today, the company is about $8.5 billion of annual revenue. 2/3 of this is in companion pets, so that's cats and dogs, and the rest is then in livestock, so cattle, sheep, swine, fish farming. The share price hasn't really gone anywhere in the last 3 or 4 years, but the underlying business has continued to tick over very, very nicely in the way that matters to us. Following our meeting, though, in New Jersey, we came back much more positive and excited about this business. Things are really changing quickly. For some time now, Zoetis has been working on osteoarthritic pain medication for dogs. Their drug, Librela, is a biologic. So that is a protein compound made in a laboratory rather than a chemically synthesized compound. Librela has now been approved and sold in the EU for more than 3 years with great results and was recently approved in the US. Zoetis is without a doubt the leader in animal biologics. What makes this Librela drug so amazing is how effective it is. It has become the new standard of care. Now, in the US, there are about 80 million dogs. Basically, 1 in 4 people have a dog, so a dog in every household. 30 million have osteoarthritic pain. It's chronic, so it doesn't go away. It's a lifelong issue for the owners and for Pookie. Currently, 9 million dogs are being treated, and most of these are being treated with steroids or cortisone, and these come with plenty of side effects: skin infections, other types of infections, liver issues, bone degeneration. There's a long list of things. Of the 21 million dogs that haven't been treated for osteoarthritic pain, they either haven't been diagnosed or they can't be treated because the side effects of the existing treatments are just too severe. Librela comes with none of these issues and complications, and the vets love it. So in the 2 quarters since approval in the US, more than 1 million dogs have been put on this biologic. Now, by our back-of-the-napkin calculation, it looks like Librela can easily add another $4.5 billion in revenue to the existing $8.5 billion on the books. This revenue comes at a gross margin of 70% and no real capex. This is the kind of growth and revenue that we like. So let's watch this space. Let's finish off. Like our respected global peers, we get out there and do the work. We have access to the same data, but it's what we do with that data that matters. We are exposed to the same risks and opportunities, but it's how we manage those risks, and our team sizes are similar. And we come with the right experience, temperament, and mindset to win. But the key thing is we are committed, passionate South Africans doing the work from here. And like the Springboks, we also outperform on the world stage. Thank you again for your time and interest. Eugene, thank you.